Accrual accounting records flows and the corresponding changes in stocks at a specific point in time. This is when economic value is created, transformed, exchanged, transferred, or extinguished. Flows and positions are recorded when a change in economic ownership takes place. Economic ownership takes into account the risks and rewards of ownership. To understand the distinction between the accounting period in which an economic event takes place and the period in which payment is made, let's consider the example of an individual buying an equity security listed on a stock exchange. On day 1, the trade date, the individual enters into a standard agreement to purchase a listed equity security. Final payment for an equity purchase typically occurs several days after the trade date. In our example, assume this is day 3. The individual has assumed all the risks and benefits of ownership effective on day 1, even though final payment for the transaction will not be made until day 3. If the equity should increase or decrease in value on day 2, the individual is entitled to the ensuing gain and incurs any ensuing loss. Thus, accrual accounting captures the economic consequences for the individual by recording the transaction as of the trade date, day 1, rather than the date when final payment is made, day 3. Simultaneous recognition of the transfer of ownership between the buyer and the seller is required for symmetrical reporting of value. This reduces the possibility of discrepancy in macroeconomic statistics, which could arise if differences in the timing of recognition resulted in the two parties using different values for the transaction. Consider our example of an individual buying an equity security. Both the buyer and the seller should record the transaction on the trade date. If one party were to use the settlement date, day 3, and one party were to use the transaction date, day 1, there would be asymmetric treatment of any change in value on day 2 or day 3. The 2019 FSI's guide recommends that the parties to a transaction in assets should record the change in position on the date of the transaction, that is, the trade date. This differs from IFRS 9, which provides the option of using either the trade date or the settlement date. This difference reflects the importance in macroeconomic statistics of symmetrical treatment of transactions across the institutional units involved.